So you would basically close down you'd have to do this in the most tax efficient way possible, which wouldn't be too hard. You'd basically close down all your shorts, close down all your longs that weren't creating you a tax problem, and then you'd be left with a basket of like these really low basis kind of like left tail, 100x type stocks, because that's where all your tax problem is. And then you could just hold on to that, obviously, or if you wanted to, you could then 351 that, because now you're 351 diversified, and then you could go become S&P again if you want it.
Wes Gray, how's it going?
Good, man. Pleasure to be here. Good to
Yeah,
catch up. It's been a while. I can't remember, when was the last time I was on your guys' pod? Maybe a year ago?
yeah,
A
could
year and a
be
half ago?
longer. We haven't been doing them as frequently, so yeah, could
Yeah.
be a while. Um, and we haven't seen you in person since the last time we went on the hike, I think.
Yeah. The last March for the Fallen Pride. That's
Yeah,
I can't even remember, man. That might have been 3 years ago.
yeah, yeah, which is
Yeah,
crazy.
I mean, we live in the
Great.
Caribbean together. We should we should be able to figure this out, I imagine. But logistics are challenging, I guess. This whole thing
Yeah,
called an ocean in between us. Uh,
yeah, I know it's a
but
major
we'll
pain.
figure it out. And
Yeah, exactly.
but
So for those who don't know, Wes Gray, founder and I guess you're CEO, right, of Alpha
yeah,
Architect?
I'm running both businesses now, the Alpha Architect biz and the ETF Architect biz, which is the infrastructure side. So,
Yep.
I drew the short straw, so now I got to herd the cats in both of them, which is always
Nice.
exciting.
You're so efficient. You probably have time to like break in horses, teach the girls figure skating. God knows what other talents you have.
I'm not that efficient, unfortunately. I probably need to, get rid of one of my full-time jobs here at this point. But yes, I am pretty dang efficient. So I do lead a pretty normal, balanced life that, despite the, despite the task at hand. Um, I don't want to do any more because, I like hanging out with my kids and everything, like I'm
Yeah.
sure everybody does.
Yeah.
Um,
Yeah. For sure.
but it's also a luxury of living down here where I live. I think it's probably similar to you guys. I live in like a golf cart community. So, my commute to school, the kids' school is, I don't know, 2 minute golf cart ride. Commute to working out is open my door. It's just, I don't have frictional time issues.
I know
So
that that time
gain a lot.
savings is the ultimate gift, right? Just not having to sit in
Yeah.
traffic ever is
No,
the
exactly.
yeah, that's
Yeah, I mean, if you do
crazy.
the math on that, that's like what, an hour and a half of quote unquote wasted time. If you just got magically, hey, here's an hour and a half, maybe even 2 hours of day, what would you do with that? Well, now you could do all like the essentials that you probably needed to do that you didn't have time for. But like a
Absolutely.
2 hour of frictional cost and just busy is not a great use of time, generally
Yeah.
speaking. So
No, I know. Not easy for most people, but
yeah.
yeah, lucky to be able to take advantage of it.
Yeah, no,
Um,
exactly. We're obviously privileged set up to
yeah,
be able to do that.
definitely.
But,
So, I mean, we've had lots of conversations over the years. A lot of them have been kind of factor portfolios, designing ETFs. All the different complexities of managing diverse product suites, et cetera.
yep.
Um, Today, we're going to focus on tax. And, we've had a bunch of conversations with different groups over the last few weeks as we've been navigating a tax optimization for a client. And the feedback we keep getting from everyone is just like the whole tax field is exploding, right? Like, I guess it's not
Yeah.
really surprising this point in the cycle. We've minted like, 100 million new deca millionaires, like the Nvidia,
Exactly.
Google diaspora, et cetera. And everyone's trying to
Yep.
figure out how they can diversify or generate income off their newfound wealth, right? So,
Yep.
and I guess, you've been moving in the same circles, climbing that learning curve as well. You're a little ahead
Yeah.
of us, maybe by a year or two. So that was the primary motivation why we wanted to connect with you today. Um,
Yeah.
just by way of background, like what got you started down the road of really wanting to climb the learning curve on tax. Like that wasn't really where you started. That wasn't a particular specialty of yours. So what motivated that?
Yeah. So actually that's how we started. So tax behind the
Mm,
scenes is always been our DNA. Um, from the very beginning. That's why we got an ETF business. So I mean, it's not like a very public thing, but essentially, going way back to the start, our like this was whatever 15, 16 years ago, like our first project was managing an SMA, doing factor investing with tax efficiency. So we
mm,
had done like the early version of, okay, we do the, hold longs for a year and a day, harvest the losses, all the stuff that, I don't know whenever direct indexing, tax loss harvesting came out, but we were doing that in the very beginning. And this was in 2010. And then very quickly I learned about the ETF wrapper, and I was like, oh, geez, that's a tax deferral in plain sight at scale. We need to get in that business because doing harvesting is a huge pain in my ass and requiring too much thinking. And so then we immediately transitioned into the ETF structure for predominantly tax efficiency reasons. And then we also started a business in a 1042 rollover, which is named after Section 1042. We started that probably, I don't know, 10 years ago. And that's a huge business we run in doing tax rollovers in the ESOP space. So obviously, once the active ETF rule came about in 2019, like obviously we were familiar with like the tax deferral or the tax structuring, like 351 and 368, all this stuff. It's just the problem is until like the ETF world was able to say like, hey, active ETFs get the same tax capabilities as index-based ETFs with respect to like customs and everything. It's there's not really much to see here. And then but obviously once that happened, we immediately pivoted, and that's why we lead and have probably done more deals in 351 than every other operator combined,
mm-hmm.
because we've been way ahead of this curve, and all we do behind the scenes is tax structuring. Um, so yeah, it's a little known history, but the reality is like we've always been tax first. You know, how do we figure that problem out? Because all of our clients are taxable, and so it doesn't really matter how much alpha you got if 50% of it you got to give back to the government. We got to solve that problem first, and then we'll figure out how to deliver, whatever alpha or strategy or whatever we're doing. So weirdly, that's something that we're actually the leaders in that, I would say, in many respects, which is why I'm so familiar with literally every single tax structure and idea and concept that's available at this point. Um,
Which is why
Also, I
you're the
live
man
in
on the
Puerto
hot seat
Rico.
today, Mark.
Yeah, exactly. So, and we've done
So
all
what?
these
So
things. Like, yeah.
say more about the 351s. Like a lot of people don't know what that means. You guys have been all over that for a few years.
Yep. So basically, Section 351 is a situation where, I mean, basically what the tax code says is, hey, if you want to contribute property to set up a new C corporation, you can do so in a tax-free manner. So generally speaking, like if an operating company, let's say, and Bob, our tax guy, he always uses like the shoe store analogy. So let's say I make pumps and you make Nikes. And we're like, geez, we'd like to set up a different business to offer both of these. So, hey, Adam, let's set up a new business. You contribute your Nikes, I'll contribute the pumps, and we'll have this beautiful conglomerate. We'll add all kinds of value. And 351 says, great, you guys can do that without taking a tax hit, right? Because if we had to pay a tax on the property that we shifted into the new business, it basically destroy capital formation, which is why 351 came into the code 60, 70 years ago. And then, of course, over time, people get smart. They add different treasury regs because one of the nuances of 351, they say that's awesome. You get tax-free treatment. You contribute property, no problem. But then, people start thinking hard, and they're like, well, what happens if I contribute property to a C corp that elects to be a RIC, i.e., a mutual fund or an ETF? And they're like, wait a second, when you're a C, but you elect to be a RIC, you guys are avoiding our double taxation thing. We gotta hammer down on you guys. So within 351, with respect to funding a RIC like an ETF, there's additional rules, and they have these diversification requirements where it's basically like for 351, you can't just take your 50 million in Tesla, turn it into an ETF tax free and then turn it into SP 500, right? That ain't going to fly. So the rules with 351 with respect to like ETF is you have to do diversified contributions because the IRS basically says, listen, if you're already diversified and you're just going to go to diversified, fine. You guys can be also tax free. But as you know, the definition of diversification in the minds of a tax attorney versus like you guys, like a financial engineer, they're very different, right? So to qualify for diversification from a tax perspective, the only rules are you can't have more than 25% in one security, which, well, that's not very diversified to most people, but to them it
Mhm.
is. Fine, we'll take the laws. And then the other one is that the top 5 contributed securities can't be more than 50% of your total. So essentially, like an 11 stock equal weight would work, right? Because you want to trigger both those. But
Yep.
that's the thing about 351 is you have to contribute diversified property. Um, and obviously that's a strict hard and fast mechanism, and obviously
Yeah.
that's, but most people have enough diversification. Their problem is they're under diversified, or they just got all kinds of portfolio complexities, or over, it's just basically they usually have a pain in the ass, but they can't do anything for tax reasons. And so 351 is basically an opportunity to kind of help them get more efficient, clean up their portfolios, get better diversification, lower costs, etc. Which is why it's, white hot right now,
Right. So
because
the
there's a lot
motivating
of
example
value.
here is you've got someone with a large single or one or two concentrated stock positions
Yeah,
that represent the bulk of their wealth. Say
yeah,
they don't want to sell it; they got a very low cost base.
yep,
So and they don't want to they don't want to go to cash. What they want is to
yeah,
just take that concentrated
yes,
stock and then transform that into more diversified equity exposure, right?
yes. Or I mean, they could do a lot of things, but yes, what they're basically doing is eating tons of uncompensated risk for no reason outside of I don't want to pay a huge tax bill. And
Yep.
and and that is literally in the intent of the law effectively, right? Like how do we help people, like how do we have more efficient capital formation, and like from a societal perspective, like you don't want people bearing the risk of all in on a single stock, generally speaking, because then it's just the cost of capital is going to explode. So all these tools, I think, from a macro perspective, make a ton of sense because they keep prices more efficient, allow capital to move efficiently, and become properly diversified, etc. And obviously, there's always got to be rules which we're going to follow. But that's at a high level. That's what basically 351 is offering people. There's just like any rules, there's a bunch of like, well, what about this? What about that? And you got to follow the rules. But generally speaking, it's a huge opportunity for value creation. Um,
Right. Okay. So you've got
so
like whatever 10 or 20 people. They all have different kind of concentrated stock positions.
yep,
The idea is you get a sufficient number with sufficient, number of positions that you're able
yeah,
to execute this 351. They all deposit their concentrated stock positions in this structure and then
yep.
you list it. Then what happens? What are the restrictions and, how long do you have to
So
hold it? What happens
yeah,
within the vehicle
there's
over the time that you hold it? How does that all play out?
yeah. So this is the beauty of a 351 deal, is there's no restrictions, right? It's not, and I'll juxtapose that against like exchange funds and other solutions out there. So in 351, all this is this is just a bona fide ETF like any other ETF after it launches, right? The only difference is the seeding mechanism. And luckily in 6011, there's actually also language, which is very important for these deals, where it specifically states that new ETFs can also, besides a broker dealer providing seed capital, they can also be seeded with property. Obviously, that's important because if the SEC doesn't like this, then who cares what the tax rules say? Because we need to be able to actually do it. So thank God in 6011 it makes it very clear that you can seed an ETF with property. So so then herein comes in 351. So but to answer your first question, once you launch this thing, it's just an ETF like any other ETF, and anyone on the street with a Schwab account can go click the button. But now let's get back to the seeding mechanism. So on the seeding mechanism, if you have a diversified 351 contribution, you're going to basically get a carryover basis. So it's not a step up, it's a deferral, right? So if you had zero basis and 100 million of property, you're just going to have a zero basis of 100 million of ETF shares, right? So you're not like becoming better off just from the transaction. Obviously, it's just a change from your current status to like ETF.
Yep.
And as you know, like the ETF is just a more efficient way to manage capital, generally speaking. So why wouldn't you want to be in that wrapper? But there's no, like, if you wanted to do the deal and then for whatever reason you're like, geez, I need 100 million. Well, guess what? If you sell your shares, you're going to have to pay the tax. There's no difference there, but it does provide an opportunity. Like I was saying, like if you want to clean up your book, get better diversified, or do whatever you want, it's once it's in the ETF structure, there's obviously just a lot more flexibility. Whereas you can't do anything if you're just holding your Nvidia and Microsoft. I mean, you're stuck. Like you're not going to do anything.
Yep.
And so with the ETF structure, like over time, depending on investment mandate, obviously you can maneuver because you have an active management mandate. Like in theory, you could contribute into a 351 deal. And if the asset manager's like, great, I want to be long S&P, just joking, I think Trump's crazy or whatever, I want to go to cash, you could do that, right? And that would be tax-free because you'd use a custom to do so. So, I mean, as long as you're always making decisions based on economic substance and like the investment merit at that time, I mean, you could use your imagination, but you could do a lot of stuff with 351. You got to be careful with like intent and like premeditation. But if there's bona fide economic investment reasons to do something, you can do it, generally speaking. Um, so that's 351, and there's basically no strings attached, but you have to contribute diversified property. Now, the other question, like people always say, is like, well, Wes, I got my 100 mil Tesla, but that's all I got. I'm like, well, obviously you're not diversified enough to qualify for 351, and you can't do this, man. It's illegal. It won't work. And they're like, well, that's great. What am I supposed to do? And you basically have two solutions, right? You can either go to an exchange fund, and we've done some innovation on exchange fund side with a group called Use Cash, which is best way to think of it is like the vanguard of exchange fund. It's, exchange funds, if you're aware, they're like these old stodgy, overpriced structured product type businesses the banks have been operating for 30 years. And it was about time a competitor came in. And so we have that competitor. It's called Cash. But so it's lower costs. There's a lot of efficiencies they have. But the key thing in the tax rule is that relates to another section called 721 related to partnership taxation. And so if you contribute concentrated property into a pooled vehicle and you achieve diversification. So this is a situation where like I put in my Nvidia, you put in your Tesla, Susie puts in Microsoft or whatever, like we all benefit because as a partnership, we're diversified, even though we each individual contribute this. Well, 721 basically says, great, you guys can do that, but there's strings attached. You have a 7-year lockup. And you can't be a Rick, and there's a bunch of other rules. But long story short, if you have concentration problems where 351 can't help you, you have to do the exchange fund, which again, there's new solutions that are a lot better than they used to be, but you always are going to have the 7-year lockup problem because that's just the tax code. So that's solution one there. And then solution two, which, I spoke to Rod about to get him up to speed on. And this is something we also did, 10 years ago, before I think even people were thinking about this, because we always do tax things. But what you do is you do the long short tax loss harvesting, right? So you kind of run like a market neutral system alongside, a concentrated asset. And then over time, when you're running your market neutral thing, you can kind of generate losses. And then as you generate losses, you can use that to kind of sell down your concentrated position, and it kind of, the basis squeezes into the long leg. So that's kind of there's other things you can do, but those are the two things you can do if you got the concentrated risk problem.
Okay. So
Which is,
with the
yeah.
exchange fund, because I often get those mixed up, right? So There's
Yeah.
you can't do the 351 solution if you have a concentrated stock position. You've
Yeah.
got 10 other buddies that have concentrated stock positions of approximately the same size. You
Yeah.
can't pool those 11 positions into
No.
an equal weight portfolio and then seed
Yeah.
an ETF.
So
Gotcha. You
exactly.
yourself
So
personally need to have a
yes.
diversified portfolio. Okay.
Yep.
Gotcha.
And the way that this was all argued about many decades ago, and the general intent of the tax code is they're like, listen, we do not like it when you go from concentrated to diversified. So therefore, we're going to require a penalty. And that penalty is that 7-year lockup and a bunch of other crap, right? However, they say, but if you're already diversified, at least how we define diversification, we don't really care if you do a 351 because in our mind, you're already diversified. You're just going to get more diversified or whatever. So the tax code is basically set up to penalize those that have too much concentration, but not penalize those that have enough that they consider diversified already, which kind of doesn't make sense because you'd almost think like if I'm like a macro, policy person trying to like free up capital with least frictional cost, you would actually think like you don't want people bearing massive idiosyncratic risk all the time because the cost of capital goes up. There's all kinds of friction problems, but that's kind of how it is set up. They actually
Yep.
make it painful to like diversify essentially. And that's why the market neutral stuff is kind of like a quote unquote new innovation where it's another alternative to the 7-year lock structure that kind of goes around the 7-year lockup. There's kind of implied lockup because it's not like you can just do that in a minute. It might take 3 or 4 years to generate it, but it's a nifty, you know, I guess quant solution to kind of, I wouldn't say go around the 7-year rule, but kind of go around the 7-year rule in some sense.
Yeah.
So
Well, you've got a lot
it's
more
kind of interesting.
flexibility, right? But maybe just,
Yes.
yes, if we don't mind. So walk us through an example. Let's say
Yep.
someone comes to you with whatever, 100 million in
Yeah.
Google stock, right?
Yep.
It says either, I want to use this Google stock to collateralize a
Yep.
bunch of other strategies and or throw off a bunch of income. Let's say for the sake of ease, it's throwing off a bunch of cap gains.
Yeah.
And I want to figure out how to manage the tax liability year to year.
Yeah.
Or I got this big concentrated stock position and I want to kind of work it down so I can slowly ease into a more
Yeah.
diversified portfolio. So I guess we can maybe take both of
Yeah, let
those
me
on their own.
yeah, let me give you the cost benefit because there's not like a panacea where it's like, "Oh, we always should do this solution, we should always do
Mhm.
that solution." So generally speaking, if you have 351 qualified contribution, there is an easy answer. Do the 351 because that has no lockups, you get immediate diversification. That is a no-brainer, frankly. If you already have diversification and you want to do a 351, that's obvious. But let's get to the contrary position, which is a lot more complicated because now we got trade-offs, right? So option one, the leanest, meanest option and I'm going to oversimplify this just for to make this simple to understand. It's not this easy, but it's basically what's happening.
Mhm.
Is I can't take like let's say you got your 50 mil Tesla. I can't take that directly. It's not 351 qualified. What if you go to an exchange fund, in particular this group Cash, who basically invented this solution, and it's a long story why other people can't do it, but there's actually a lot of IP involved. But so I was giving the nickel to her. So I can't take the Tesla. Hey, call up these Cash guys, all right? And what are they going to do basically? Well, they're like, all right, we're trying to manage to an index, and I've got Adams, Tesla, I got Susie's, Nvidia, blah blah blah. They, at the partnership level, might be able to get a diversified portfolio that they could contribute to a 351, right? And this is exactly what we actually did on one of our deals over the summer with AAUS, where the exchange fund was actually like 130, 140 million of the, almost 500 million total capital. They were a big contributor. And so let's say 300 and change was like normal 351 folks. The rest was an exchange fund contributed, right? And so what happens there is exchange fund contributes these securities under 351. I can give them back the ETF shares, and they can do that in a tax-free manner. Now, they have a problem on their side with all the legalities and structuring and how to make sure that all this is kosher. But essentially, you as the person that says, hey, here's my 50 mil Tesla, effectively, you're going to become S&P 500 the next day. And you're going to have to hold this for 7 years and, be exposed to S&P 500. I guess you could hedge against it if you wanted to in another account. But, you're basically going to go Tesla immediately to S&P 500. And then after the 7-year hold period, when the events aren't deemed taxable in redemption, you can say, hey, give me my collateral. And then you'll receive out the ETF, and then you just walk off to the sunset. That's solution one. And they've got the cost on the all-in cost on that to probably depend on your scale, anywhere from like 30 bips to like 100 bips all in, which is great, right? And if you have a lot of scale, you're going to be in like the 30 bip range. If you do like 100K, it's obviously going to be more expensive. So, and that has like different costs and benefits. And then on the long short side, what you do is you're like, all right, great. I'm going to get my 50 mil Tesla, hold that in my brokerage account, use that to borrow and fund a market neutral long short strategy. It just, say it's 1,000 long, 1,000 short, it's doing some factor thing or whatever. But let's just pretend that it's a break even strategy. Like, it's, you're not good at picking factors in the end. And you're just like, let's just abstract from the investment part and just talk about the tax part. So let's say you have the 50 mil Tesla. You're like, great, we're going to go put 10 million in this market neutral strategy. It's going to go long 1,000, short 1,000. And then, it generally speaking, it differs year to year, but you might be able to generate, call it on that 10 mil, you might be able to generate 5 mil a year or 10 mil a year in losses, right? And so let's say you get that 5 mil a year in loss. Well, now I can take that loss, pull my Tesla down to 45 mil, unhedge, and then I'm usually going to be basically long 5 mil of the 1,000, leg of my market neutral portfolio. And I've kind of effectively, moved from, instead of 50 mil all in Tesla, I'm now 45 mil Tesla, 5 mil kind of like a random 1,000 stocks long effectively, right? And then if you do that for, let's say, 4 or 5 years, maybe you get the Tesla position all the way down to zero. And now all you have is basically a bunch of basis in, 1,000 random long stocks. And maybe you've already unhedged your short side, and you've kind of transitioned your tax problem from Tesla into these, well-diversified long leg, essentially.
Right.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsalt.com. Now back to the podcast.
Right. So maybe just let's get one level deeper and sort of work through the mechanics of how those tax assets are crystallized on an ongoing basis. And then there's like you say, there's often a residual of kind of this long portfolio.
Yeah.
Why is that? How does all that work?
So generally speaking, on average, and this stuff's extremely complicated because it's all path dependent, obviously. So, so usually the operators that do this, they're going to have like their Monte Carlo. We're going to simulate 10 million simulations of this. But generally speaking, over long horizons, beta works, right? Beta pays a premium. So just owning risk, on average, it goes up. So if you're long 1,000 stocks, and you're short 1,000 stocks, and you're sector neutral, everything neutral, because you can't be long and short the exact same thing because you create like straddle problems and some other issues. But you can, as like a quant, you can effectively be long 1,000, short 1,000, and not really be taking that much risk. Like you actually want to take risk for tax purposes, but you could engineer in theory something that basically has no risk effectively, just for easy math, right? And then what happens is the short positions are on average always losing because they're short the market beta, right? So usually you're going to get your losses in your short book because just if the market kind of naturally drifts over time, you're always going to be just getting dinged on your beta on the short book. So you're usually like banking your banking losses there. And then it also requires obviously the manager to make sure they know their exposures. Because if great, like I'm just making this up. I'm short Nvidia. Well, that's actually a bad example, but I'm short whatever. Some stock that doesn't go up 10,000%, like whatever, some random stock. Let's say the market goes up 10%. You actually lost 10%. So you might, if you thought it made sense, you would actually cover that short, right? Bank the short-term capital loss. You'd have to do some management because now you're not exposed anymore. You'd have to figure that out. But then over time, as you're doing these kind of trades and you're like banking, like whenever something's in a loss position, either on the long or the short side, you bank it and then you either hedge it, you wait 30 days because you got to deal with the wash show rules too. The main idea is over time, most of your losses are generated in your short book, some on the long book. But in the end, like after 5 years in these programs, pretty much all your basis is going to be buried in like 10 to 20 long names. It's going to be like what you would expect. Like right now, it's going to be Nvidia, Microsoft, Tesla, these sort of things. And then you're going to have a long tail of like long names that kind of have some basis. They got some tax issues, but not a ton. And so what you would do at the end of this life cycle is like, you're okay, great. I finally got rid of my concentration. Now I'm in this crazy complex market neutral thing that did its job, but do I really need all this complexity? No. So you would basically close down you'd have to do this in the most tax efficient way possible, which wouldn't be too hard. You'd basically close down all your shorts, close down all your longs that weren't creating you a tax problem. And then you'd be left with a basket of like these really low basis kind of like left tail, 100x type stocks, because that's where all your tax problem is. And then you could just hold on to that, obviously. Or if you wanted to, you could then 351 that, because now you're 351 diversified, and then you could go become S&P again if you wanted, right? So I mean, it's complicated, but if you just were really crazy about like diversification and planning, you could do things like this, where you actually piecemeal these different programs, after they've kind of done their value add, and then you
Yep.
keep rotating into the next thing.
Yeah, it's
Yeah.
funny because
So,
there's also
yeah.
this, like you said, right? There's this path dependency to it where,
Yeah.
under the simplified kind of expectation model, obviously beta goes
Mhm.
up. You're
Yeah.
going to crystallize all your tax assets on the shorts. You're going to
Yeah.
have this kind of weird concentrated portfolio of, the Nvidia, the Mag 7 and,
Yeah,
four other stocks.
exactly.
And
Yep.
then, you've got this kind of problem. But of course, you know, typically markets don't go straight up, unlike
Yeah.
what we've seen over the last few
Yeah,
years.
yeah,
But
exactly.
typically, you do see kind of like this. Sometimes you get these choppy periods, you get
Yeah,
these
yeah,
sector
yeah.
rotations, and you
Yeah.
do get this opportunity to kind of rotate through some of your long book, crystallize some losses
Yes.
there,
Yep, which is
re-diversify,
awesome.
re-up. Right, right.
Exactly. You just need like a quant or like someone with computers, obviously, because to your point, it's weirdly, you actually want a lot of volatility if you're trying to get rid of your Tesla problem. Because to your point, the more you got things zigging and zagging, that's just more opportunities to take this tax loss option and just bank these things. So even if the market doesn't go anywhere, but just stocks move, you're still going to be able to generate a lot of losses. It's just now where your basis is might be not what we talked about initially there, like over a long horizon.
Mhm.
It might just be spread all over the place. Um, and that also gets complicated because, the issue is on like short side, for example, like there's no such thing as a long-term capital gain from a short position. Like at least
Right.
and maybe the code's changed, but at least last time I looked, like even if you hold a short position for like 2 years and you're like, all right, fine, I'll just cover it, they're going to still ding you with short-term capital gains. Whereas
Mhm.
obviously you don't have that treatment on long positions. So all else equal, you don't want to be like having to like or push your unrealized basis into short positions, because when you do have to finally pay the man at some point, it's not capital gains long term, it's short term capital gains, which is double the rate. So you don't want that outcome. Obviously, but that would be something when you simulate, you're like, that would be one of the outcomes where you're like, yeah. If you read, like, AQR has a bunch of papers that do exactly what I'm talking about. They
Mhm.
simulate, 10,000 runs, and they kind of give you like the confidence bands of like, well, after 3 years, you're going to be between this and this. After 10 years, and they're basically highlighting that it's all path dependent, and all we can do is give you kind of a cone of expectations, but obviously, unfortunately, you get run one roll at the dice here. We only have one observation, and you're just gonna have to deal with that. So all we can do is just invest ex ante, the best we can, but we can't predict the future, obviously.
Yeah.
Um,
Yeah, exactly. And then,
but
yeah, so if you kind of get lucky in a weird way and the market
mhm.
ends up being choppy, you can
Yeah,
end up getting off your concentrated stock position relatively quickly with effectively no kind of residual,
yeah,
major long book,
exactly, more
right?
limited. Yeah, you're gonna get more limited issues in your long and your short book, but generally speaking, you're usually going to have some tax problem. You can't eliminate the tax problem because it's like the physics of tax. It,
Mhm.
it's it's going to get squeezed somewhere. It's going to be unrealized somewhere else for sure. Because you can't like eliminate it through these mechanisms. I've actually thought about that because we run a whole business that has been doing stuff like this in the 1042 side for a long time, and we almost tricked ourselves. We're like, oh, like I remember Doug. He's like, Wes, we got to do this. I'm like, Doug, oh my god, and we literally had to go on a whiteboard and go through step by step because I was like, we're missing something. There's no way there's no way they could have wrote that code where we could have outsmarted it such that you eliminate the tax. It can't be possible. And sure enough, it's just physics of tax. There's unless you die, there is no way to eliminate it. Like if you want to kill yourself, great. They'll give you like that way you can get rid of your tax problem, but you got to die. That sucks. But generally speaking, the tax burden will be somewhere. It just we just got to know what form it showed up in. It's going to be squeezed into the either short leg or long leg or somewhere. There's just no way to not have that be plausible. Unless of course the initial problem, like let's say in this case your Tesla, it goes down by 50-60%. You don't have the tax issue anymore. That's a good way
Sure.
to
Which is
also eliminate.
not exactly what you want, right?
But yeah. So the two solutions to eliminate tax problems are die or lose your ass and not have the tax problem. But those are
Yeah.
also, corner solutions that suck. It's not
Yeah.
like an equilibrium that any of us want. And so I would say it's always going to be the case that it's just a matter of when you're going to pay the man, but you're going to pay the man at some point. It's just, can I at least make this ride more diversified and more efficient as opposed to just, doing the Bitcoin trade. Just, I'm just long and strong till it goes to 1 million, and I'm going to endure 10-90% drawdowns along the way.
Right.
I mean, you guys write about that all the time. Like there's a utility benefit to not have your curve go like this all day and
Mhm.
like kind of make it wiggle a little bit less on your way to whatever financial objectives you got. And so that's really kind of
Well, and
the
also
best thing we can do.
recognizing, was it Bessembinder or whatever and I
Yeah.
think there was a more recent
Yep.
study who showed that like
Yep.
only 3% of stocks actually over the long term end up going on and delivering all the index performance, right? So if only
Exactly.
3% of stocks end up going on and persevering and delivering returns above like cash,
Yeah.
then what's the probability that your concentrated stock position is among the 3%,
It's
right? Like it's
damn
just
near zero.
enormous hubris.
Exactly. Yeah,
Yeah.
and I'm sure some academic or quant could like map out like the utility of that. But I mean, it's got to be the implied loss of expected return and utility benefit. It's got to be insane, Matt. Like,
Yeah.
I don't even know, but it's terrible. It'd be like equivalent to saying, do you like investing in equities and earning a negative 20% equity premium? You should buy this idea. Like it's going to be something like that absurd where if you framed it in the correct manner, people would be
Yeah.
like, why would you ever do that? That's totally insane. To which I'm like, well, yeah, no shit. And yet people do it all the time.
Uh, Uh, it's true. But, the
Um,
weird thing is, of course, right? Like that is the way that people become multi-billionaires, right? Is like, taking
yeah,
these crazy,
yes.
massively
Well,
hubristic,
and to be
negative
fair,
expectancy parts.
the other thing is, and Elon's done this. All this is all like the billionaire tricks, which is how we were raised. You can always go to your friendly banker and say, "Hey, can I pledge this Tesla for like cash?" And they're like, "Well, yeah, of course you can." And remember, if you take loans against your position, that's tax free, and you could go buy SP 500. So there's all if you're rich enough and you have enough banker friends and you're doing everything within the letter of the law, you can already do a lot of this and get rid of those
Mhm.
problems. It just because and it makes sense that you do so because even though you gain so much utility benefit in the vacuum, if you have to pay 30-40% in a capital gain, like it's worth thinking about how do I do this? Because that's like a huge problem. And
Yeah.
that's why obviously people spend so much money and time on trying to figure out a tax efficient solution because it's just the capital gains, the state, the Obamacare. I mean, it's crazy.
Yeah.
Um,
Now,
you know.
what about a client who really is like a true believer in the concentrated equity position that they have?
Hmm.
They want to just, drop that in account. They want to use that to collateralize
Yeah.
a diversified, set of overlay type strategies. But
Hmm.
the overlay
Sure.
strategies are going to kick off a bunch of, tax liability as well. Is
Yeah.
there some kind of equation there where you can kind of pair the market neutral tax crystallization strategy with this other like set of diversified strategies and use that to kind of maximize the after tax yield on the overlays?
Yeah. Yeah, so what you would do is kind of what you guys already do in your business. Like, hey, you obviously have to have a positive cost to carry. So if I have, let's just make it up. I have 100 mil Tesla, and I am such an Elon fan. I'm not selling this. I don't care how many Best and Binder studies you give me. I'm just a religious believer.
Yeah.
Fine, we're not going to argue about that. Like,
Yep.
it's just we'll give it to you. So what can I do for you? Well, what I can do for you is if I borrow against that position, it's going to have a cost to carry because obviously the broker's going to charge me whatever, Fed funds plus some haircut. But and
Mhm.
let's just say for easy math, that's 5%. But you're like, well, guys, it cost me 5%, but I can take that capital and go invest in like merger arb, market neutral, trend following, all the 10 different games that maybe you guys would invent, like all the kind of like totally uncorrelated, like the classic kind of portfolio theory. Put a bunch
Yep.
of totally random shit together. And even though all of them individually look crazy, as a bundle, you created like a T-bill, basically, right?
Mhm.
So if you could say, hey, I got this bundle over here, and it actually earns 7%, and it only cost me 5% to fund it. Well, that's a positive carry trade for free, assuming you could deliver the 7%. And not only that, because of what we were just talking about, all the tax optionality, behind the scenes, I can always take options on banking losses for a rainy day. So then I could also generate some quote unquote like tax alpha, if we're going to call it that. Right. So in a
Mhm.
perfect world where you just have someone who's a maniac and they're just like, Adam, you're an idiot. Shut up. I'm rich. You're not. And Tesla made me a gazillionaire. I'm not leaving. Fine.
Mhm.
How about this, bro? We're gonna run like an overlay funded with the collateral, and I can convince you I can beat your cost to carry, and so you basically get quote unquote free money and tax loss benefits. Obviously that would be a good pitch. Assuming you could deliver on the value. You don't want to have negative cost carry, obviously, but if you could actually generally convince someone of that and you could execute that, that's a great idea.
And the
Uh,
cost of the borrow too is
mhm.
how's that treated for tax purposes?
It's so generally speaking, like interest expense is deductible, I think, against like other investment income. That's like so I'm not a CPA. I don't do I'm not like a CPA day to day. I can't remember those rules. But margin expense, like margin interest, is deductible against other, I think, like qualified investment expense income. So like you
Right.
can't use it against like your business outside of your investments or like your W-2 income, but you could use it against, let's say, you own something that provides income, like you own some bond or whatever, right? I'm pretty sure you can use your margin expense on that loan against that, right? That's something that, because that gets super in the weeds real quick, and I'm not
Yeah,
a
sure.
tax attorney or whatever, but like
Mhm.
CPAs are all over that, and they'll be able to say like, oh, well, this one can match that one, but there's certainly, it's not all bad, because of what you said. Like it is definitely deductible against something. You just want to make sure that you have something it can be deducted against to make sure you can use it.
Right. Right. And are
But
you seeing, is this becoming something that you're getting asked about, or is this still kind of an under the radar kind of
no,
strategy for
I
those who
think,
really want to maximize their like capital utilization?
yeah, I mean, I personally do that. Like I borrow against my stuff and go put it in funds that do this kind of stuff. And I'm almost positive, I don't know, but if you went to go do the funding sources on like the Citadel Hedge Fund, Millennium, all these like prop shops, I can almost guarantee that's people that are funding those LPs with borrowed money, right? Because if I can go borrow money from my broker at 5%, go give it to them, like I would venture to guess that a vast majority of the capital they have is not like clean money where
Hmm.
people just took cash that was just sitting there. It's probably almost certainly overlays indirectly.
Yep.
And so I already think that's a massive, huge business out there. I just don't know how much has trickled down to the ultra high net worth taxable folks out there. I mean, I recommend it all the time, but I don't, it's not my business anymore.
Yeah.
I'm buried too much in just doing the tax structuring with ETF stuff. We
Hmm.
can't do all this stuff, but yeah, someone should definitely, duh. This is obviously a huge business opportunity. And I know AQR does it, some other guys, but I mean, this should be way bigger opportunity. But as you know, the problem is it's complicated.
Hmm.
So you got to explain all this, how the financial engineering works. And so there's a massive educational tail, but it's obviously a great idea because it creates a lot of value. Uh,
Yeah. I mean, at its simplest, right? You got $100 million in stock. You go drop it at an Interactive Brokers. You take
yeah,
them. You literally just withdraw half of it as like a margin loan, right? And then you
yeah,
just take it, and now you've got to potentially manage margin calls, and you've got to have
yeah,
sufficient
of
liquidity. Like
course.
there's operations behind that, right? And then
Yes.
obviously if you've got like Interactive Broker account, and you could just
Hmm.
assign people to run,
Yeah,
future strategies or market neutral strategies collateralized with that
exactly.
stock right in, and or whatever, wherever you want to have custody. But
Yep,
yeah, it's just like so many different
exactly.
options that nobody ever thinks about. It's a huge,
Yeah,
new
and you guys
new
kind of do that
opportunity.
on return stacking. It's a different mechanism, but the idea is like, all right, you have all this collateral, but you can't do anything with it because it's
Yep.
stuck for taxes. That doesn't mean it's worthless because it's collateral. I could use that to get margin and then go fund other games out there, right? It's
Yep.
just and that makes total sense. It's just being capital efficient, basically. And I don't think I think it's a huge business amongst like the billionaires and because obviously the banks pitch stuff like this all the time. But
Mhm.
I don't know how much it's pushed down into like the small millionaires or like the RIAs and this sort of thing. I think it's getting there because like all those big shops are already selling like the tax loss harvesting thing now to like
Mhm.
RIAs. So I assume the next step would be like, what about overlays? Which is basically what they're already doing. But there's huge room in that marketplace, for I
Yeah.
mean, basically for guys like you. Like, I mean, you guys are in that biz. And now you just got to go find people that are like, oh, that's a good idea. I listen to this podcast with you idiots talking. How do we do that? It's
Exactly.
just, it's just things like this. People just got to be aware that that's a possibility. Um,
What about
so,
funds? Have you heard of funds that are like, we've heard that one of the big managed futures funds,
mhm.
they run their typical trend following strategy, but then
Yeah,
they also run a market neutral strategy in there to offset a lot of the
yeah, yeah.
tax liability from the futures trading. Have you been
Yeah, of
seeing?
course.
Yeah.
We did that for 15 years. Um, at IB. The problem is IB started jacking up like margin requirements on things, so we kind of got out of that. But yes, you should if you're doing any strategy that creates tax leakage, and you can fund another strategy that can decrease tax leakage, you should do that. So
It's
yeah,
just crazy
that's
because we don't see that in like a mutual fund space at all, except for like a handful of obviously
yeah,
funds from managers that specialize also in the tax
yeah.
harvesting area,
Yeah. Well,
right?
the problem there though is like in registered funds, we have to qualify as a RIC. So the issue is like the problem is you got in order to be able to do like futures, a lot of times you got to set up the Cayman to avoid the bad income problem. And now you
Hmm.
just turn 60/40 capital gain into income. Well, guess what? The tax loss harvesting programs don't create capital, they don't create income
Income
losses, they
losses.
create
Right.
capital losses. So
Right.
you just
Right.
shot yourself in the foot. But LPs and partnerships should 100%, like if you're running like a future strategy or anything that's generating like mark to market 60/40, you should definitely be running market neutral as well because now you can help, you get an alternative exposure. Obviously, that's cool, but also from a tax perspective, you have like a little engine that's like punting out your 60/40 all the time.
Hmm.
So yeah, that's I mean, I would assume a lot of people do that, that if they're dealing with like taxable clientele. And unfortunately in our world, because I've had people ask me that, like, hey, why don't you run this inside the ETF? And and as like, one, the RIC is a huge pain, but then
Yeah.
two, can you imagine if we went to a market maker and said, hey, we're gonna run this long only thing, and then we're also gonna do a market neutral long short? They're gonna be like, what planet do you live on? Get
Yeah.
out of here. I'm not market making anything that smells like that. Because we just have like so many more constraints from just like an interactive broker's account. Unfortunately, it's just not viable. But in private accounts, SMAs, LPs, obviously you can do whatever you want. Um,
Yeah.
so
I mean, like the ETFs, the structure itself, I guess not for like a pure future strategy, but the structure itself already has a bunch of tax advantages. The
yeah,
mutual fund,
exactly.
can't really compete there, but they might be able to compete by bolting on this kind of, tax management strategy
They could,
as well,
yes,
right? You can imagine like a managed
100%.
futures fund typically has like there's a commodity blocker, which is the Cayman
Yep,
fund where
yep,
you trade all the commodity contracts, but there's also a
yep,
bunch of
yep,
financials,
yes,
right? You don't
yep,
put in the commodity blocker that you might be able to offset a bunch of the tax from trading the financials. So there's,
yes. And
I,
I don't. Yeah, I would look at the AQR funds. I haven't studied them, but almost certainly like they're big mutual funds because they're obviously like one of they're big in like the harvesting, market
yeah,
neutral harvesting. I can't imagine that they haven't magically created less distributions in their mutual funds over the last few years as they've kind of been like, oh, duh, we should probably
yeah,
get tax efficient now because everyone hates us, which,
yeah,
should have thought of that 10 years ago, guys, but I get it. But better late than never. So now that they're like cognizant of this, I'd imagine they're getting benefits in other areas of their business, and they would be like the ultimate candidate that I would look to see evidence of that because
yeah,
that seems like a no-brainer to me.
yeah. We're definitely kicking the
For sure.
tires on that. That's I think that's a really interesting new
Yeah.
place to kind of seek some
Yeah.
at least like operational alpha or whatever you want to call it. But
Yeah,
it's
yeah, yeah, for sure.
yeah,
I
yeah.
mean, the
So
downside is obviously the pain. Like we used to run market neutral strategies back in the day, and as you know, like running a short book, it's crazy, man. Like, I mean, because you're getting recalls all the time, and as you can imagine, that's really complicated when you're also dealing with tax. Because it's one
mhm.
thing to have a recall in a short position where you just lost money, but now let's say that recall happens and it's in like a gain, like let's say you're
Mm,
short Nvidia or something crazy, and it's just well, actually that one would be all right because it would force you into a loss. But let's say you have like a big loser, like that. Now you have like a massive unrealized capital gain, and all of a sudden you get recalled, and now you have to realize it. You kind of like destroyed the whole purpose of the program in the first place. So
yeah. No, it's
yeah,
true.
it's that
Yeah, you just introduced
you
new risk.
earn, yeah, you're earning your management fee. I would say if you figure that out. So you're not going to get Vanguard offering that for 3 bips, for sure. Um, they'd be like, you're crazy. So definitely an
Exactly.
opportunity, I think.
So what if the box trade too? Like you've got all these players out there that hold all this treasury collateral that's picking up
yeah,
regular income um,
yeah.
as a tax liability. Are you starting to see like major funds begin to swap their treasury collateral for box?
Yeah, I mean,
First of
we
all, what's
don't,
the box
yeah, we don't,
ETF? What is that? Say more about that, and then we'll talk about
yeah.
we'll
So
start to
here's the
use it.
problem with Box, right? The problem with Box is we can't talk about tax because of Section 1258.
Mm.
So we never make any public statements about the taxation of Box because it just actually causes problems for people. But generally speaking, abstracting away from any conversations, even quasi related to Box, the ETF, it just for the record, like where I'm not about what I'm about to say has nothing to do with that, has no implications, blah, blah, blah. We're not talking about Box, the ETF. Let's just talk about setting up a box spread at your Interactive Brokers account on SPX options, right? SPX options, as you know, that's an index-based ETF technically. Index-based options fall under Section 1256, so they're going to get 60-40 treatment. A lot of people, and I don't comment on what is right or what isn't right, but if you do a box right now at Interactive Brokers and you set up a box on SPX, and let's say you do it for $9.90 and whatever, 3 months from now, you get $1,000 in your account. That's going to be marked on your 1099 as it's coded in 1099 system as 60% long-term capital gain, 40% short-term capital gain, and that's how it's going to be reported to the IRS. And most people that I know and have talked to, who actually vast majority, would say, well, yeah, you're good. That's 60-40 capital gain. So T-bill equivalent, that ain't going to work because as you know, if I buy the T-bill at $9.90 and it accretes to 1,000, that's income. There's a big difference, as we're talking about here, between income and capital gain, even if it's 60-40 mark to market. So if you're running like those same trades, like you're doing a box spread on your collateral, you're going to earn T-bill usually plus a little bit. So there's also a benefit to doing it because you actually get more than your collateral. You got to worry about like the haircuts because sometimes brokers give you a big haircut. They shouldn't, but they sometimes do. Yes, all else equal, if you were doing box spreads on SPX 1256 options, which most people do, and you could do that for a vast majority of your cash collateral, and then some of it will have to be in T-bills because brokers aren't going to let you do 100% box because it doesn't count as much as obviously as a T-bill. That is going to be a lot more tax efficient because now your collateral is generating like capital gains, not income gains. And then if you're running other systems that are doing market neutral, whatever, then the whole enchilada, can obviously be more tax efficient, which is awesome.
Amazing, yeah. So
I
like
don't
an
I don't know
investor,
people do that, but yeah. Well, actually, Jeff Yaz's tax returns were released a few years ago during the Biden kerfuffle there, and that guy makes like $1 billion in income, and he pays a 20% marginal rate. So do the math. Like, these smart quant guys have probably already doing all the stuff we're talking about. They're like, oh yeah, we've been doing that for 30 years now. Because there's no way you could have a 20% income tax rate if you make billions of dollars. You have to be doing stuff like this. And so I'm sure there's OGs behind the scenes where they're like, wow, you guys just figured this out the last 5 years. We've been doing that in our garage for 40 years now. Because a lot of these tax codes really, frankly, haven't changed that much. It's just there's more and more. It's just the transparency is probably coming to light, I would say.
yeah,
So,
absolutely.
and then there's even more crazy stuff. We don't need to talk about here, but they have these things called swap funds now, and it's just if you start digging down this rabbit hole, you're like, oh my god, this is insane. And that even makes it more complicated. It's not even worth. We could have a 5-hour conversation just on that, but what you're talking about, all these ideas, there's so many opportunities for tax alpha Just because I don't think a lot of people are trained in tax. They're trained in like expected returns, all your kind of academic things.
Yep.
So
Yep.
this is definitely a blue ocean, I think, still for a lot of people.
Yeah. It's really cool. It's been neat to climb the learning curve on this over the
Yeah,
last few months and see all the different directions that you can take it. And it's
yeah,
definitely an idea which time has come, like just in terms of the Overton
yeah,
window. Like it's amazing.
yeah,
Just everyone seems to be really interested in this now.
yeah,
Again,
yeah,
probably
yeah.
not surprisingly given where we are on the S&P and stuff, but it is neat
Yes,
anyways to see it
and
all.
and I would guess if you went back in history, if you were like a tax historian, I'm sure maybe it's not this because this is all public market stuff that we know about. But I bet you anything like the demand, like in other kind of, now I won't say it's a bubble, but when we're in like these crazy markets, I bet you
Yep.
anything like the bank structured product desk, it's just white hot business.
Mhm.
I'm sure even right now it's just white hot. And I'm sure if you went back to other big market bubbles like this, the rich guys are like, "How do I deal with this problem? Can you do something for me?" And of course, your friendly banker's always going to be like, "We'll get back to you."
Definitely.
Yeah, and there's just so I'm sure we're just in another one of these things because there's just demand for services are so high right now.
For sure. For sure.
But
Awesome. Well,
all
look,
good.
I kept you for the hour that you promised, and you've been a wealth of knowledge as usual. Thank you so much for sharing. Are you guys still doing the March every year, or is that
Yeah,
kind of
so we're changing it. So we like after COVID and just because of logistics and a bunch of other reasons with like the National Guard and the guys operating it, it just wasn't going to work, right? So we are going to start a similar one, but we're just going to do it for like a client team only thing because we have such a big team. It's like, just that is going to be like 100, 200 people. So we're working on something that's like part of like we also host these like Marine Corps ball things now every 3 years. So we're thinking next year we're gonna do like this massive like Marine Corps ball for civilians for like all the ETF clients and like on the servicing side. And then just because you gotta haze people, we're gonna do a little March for the Fallen. Just remember that stuff. So once we get plans on that, I can talk to you guys. About
yeah,
it
that'd be
because you
awesome.
guys are kind of OGs on that, and it might be fun to rally up the troops there. But yeah, so we are bringing it back, but it's been a it's been a challenge to try to
It's
figure
a
out how
new
we get
spin
there.
on it. Yeah.
Yeah,
Okay.
exactly. So same idea, same function, but different venue, different setup, and everything. Uh, but
Fantastic. Love it. Okay,
cool.
man. Well, we're gonna have to get the Caribbean crew together at some point, but until then, enjoy your
Yeah,
time down there, and thanks
you got
again
it.
for sharing. And
Yeah,
we'll chat soon.
I love it. We'll see you, Adam. Good
All
luck
right.
out there, man.
Thanks, man. You too.
I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.